Hi there, welcome to Neppy Invest. So I've decided to spread my investing wings. So since I've started investing quite a few years ago, I've only really invested in Australia and on the ASX, but I think it's time to spread my wings in the international market, research these companies, these wonderful companies that are listed on overseas markets, particularly on the American exchanges. And if you asked probably any fund managers what the best companies in the world are, I think you would find companies like Apple, Amazon, Microsoft would be on a large proportion of those fund managers' lists. So in that sort of thinking, I thought, let's just start at the top. When I'm researching companies, I'll start to research at Apple and Amazon, the two A's. And I've already done the Apple video a few days ago. Apple actually did disappoint me. And the main reason it disappointed me is because they've had no revenue, operating cash flow, or profit growth over the last 5 years, even though their share price has grown at 33% per year. So there is a lot of risk associated with Apple. And I came in sort of blind with Amazon. I did know a lot of people do think they are very expensive, and I'll get into that later. They actually are expensive, but there is a reason behind why they are expensive, why the market is willing to pay a little bit of a premium to Amazon. And after I've done my analysis over the last few days, I've decided that Amazon is a buy for me. So this video, I'm going to tell you why Amazon is a buy for me, and I'm going to emphasize for me. Now, everyone else out there watching this video, you should have your own investing philosophies, investing strategies. So even though it might be a buy for me, it may not be a buy for you because it may not fit within your own investing strategies. So let's get stuck into it, and I'll discuss why Amazon is a buy for me. So first thing I'm going to look at is the charts, a 15-year weekly and then the 1-year daily chart. So this looks, don't really squint at this. The main thing to take away from this 15-year weekly is the exponential growth in the share price over the past 15 years, especially the past 4 or 5 years where the share price has really gone through the roof. Now, typically, I don't like to see exponential growth in prices of anything. That is a sign of potential bubble unless the share price is underpinned or supported by a corresponding exponential growth in the finances. So finances, I'm talking about operating cash flow mainly, but you also can look at revenue and profits. So when I see this or saw this, I thought, oh no, this is just like the Apple share price chart, which was growing at an exponential rate, even though the financials were fairly flat over the last 5 years. So I decided just to hone in on the past year. And naturally enough, during the COVID-19 financial panic back in March, we didn't see much of a share price drop in Amazon. And that makes sense because companies like Amazon should do very well out of people being stuck at home, lockdowns, that sort of thing. People will be ordering more stuff online. But really, the online services they have really wasn't this thing that really intrigues me about Amazon. It's actually their web services, or AWS. I've also noticed over the past about 3 or 4 months, we've seen a symmetric triangle developing. And a symmetric triangle is where you get lower highs and higher lows. And that could be bullish. It could also be bearish at times. But I'm going to be waiting for a bit of a breakout on that and potentially a little bit of a buy for me if it does do that. So I've looked at the charts. Now I'm going to look at the financials. And what I've done here is going back the last 15 years and looking at share price, revenue, profit, and operating cash flow growth. Right at the bottom there, I've got the compound annual growth rate of all 4 of those. So you can see the share price has grown at 35% per year. So if you've been a shareholder since 2005 when you bought at $47, you are very well off if you haven't sold out. So this is a classic example of why the saying, you never go broke taking profits. This is why you should not always listen to that. In fact, I'm not a big fan of that saying because people who just take profits because the share price has gone up a little bit tend to not really grow their wealth all that much. You don't have any losses. Sure, you might not have a lot of losses, but you don't really see those massive gains when you hold a company like Amazon for the long term. Now, the other main thing I really look here is the operating cash flow growth, and that's sort of mirroring the share price growth. So share price growth over the past 15 years is 35%, and the operating cash flow growth is 36% per year. So that shows me the market really is focusing on the operating cash flow as the thing that is driving the share price growth moving forward. And they're just continuing to grow that operating cash flow. In fact, over the past 3 quarters or so, or 4 quarters, so that's what TTM is, trading 12 months. We've seen significant growth in those past 12 months. So very exciting, the numbers these are when you see operating cash flow growing at 36% per year and continuing to grow at that rate. And I'll get into the last 5 years in a second. So what I did is just graph those revenue, profit, operating cash flow. And what I want to see here is an exponential growth to mirror the exponential growth in share price. And we've got that. So this is a little bit different than the Apple. The Apple share price was growing exponentially, but the finances, the operating cash flow, profit, and revenue weren't. They were stagnating over the last 5 years. And this is a good thing. This means that the Amazon share prices, there's some substance to it. There is a reason why we're seeing the Amazon share price grow the way it is, even though, I'll get into a second, even though it is expensive by some of those metrics some investors and professionals use. So what I've also done here is broken down the last 5 years, the last 10 years, and the last 15 years of growth. I've also included the last 5 years trailing 12 months. So that means the last 5 years trailing 12 months is I go from the last quarter and go back 5 years. The last 5 years, I go back to the previous year's results and go back 5 years from there, if that makes sense. So what I'm looking for here is better growth over the last 5 years. And we've definitely seen that. So the compound annual growth over the last 5 years from the previous results was over 40% per year. That's significant, that's amazing. And even the 5 years trailing 12 months, we're still looking at 35 to 36% per year. And over 15 years, share price is growing 30% per year. Operating cash flow is about 32.7. So massive, massive growth in Amazon, and no reason to see this can't continue moving forward. So a lot of people look at PE ratios and some other ratios to judge how expensive or cheap a company is. So PE ratio is on the far left there, and we're seeing massive numbers there. So currently it's 92.8, and that's going to scare a lot of value investors because they're going to run for the hills because that's a huge number for a PE ratio. The main ratio I look at is enterprise value over operating cash flow. And that is fairly high even for me at 29. But I think there is a reason behind these high numbers, and that's the significant growth rate the company is experiencing. So I think with Amazon, focusing on these sort of ratios is probably foolhardy, not wise. You should be focusing more on the growth, what's happening with the operating cash flow growth per annum. So the last thing I wanted to look at, I just went past to the most recent quarterly earnings report. And I just wanted to see how they're doing in different segments. And the main thing I really wanted to see how they're doing with Amazon Web Services and how that compares to their online services. So the top table up there breaks it down to North America, International, and Amazon Web Services. And the main thing I take away from this is the massive margins in Amazon Web Services compared to their online sales. You can definitely see that. Just go to North America, net sales of 59 billion, but only profit of 2.2 billion. So margins there are not high at all. But look at Amazon Web Services, sales of 11.6 billion, but profit at 3.5 billion. So massive amount of margins there. And the profits they're generating in Amazon Web Services already dwarf the online sales. So that's huge news for me because I think they're going to see substantial growth in the Amazon Web Services moving forward. Cloud is the future, and I think cloud will grow substantially over the next decade, even possibly longer than that. And you can see on the bottom one there, they've broken it down even a bit further to online sales, physical stores, third-party seller services, subscription services, AWS, and we see here the pretty strong growth in, this is revenue, in or sales, this is in sales, so fairly strong growth in sales in quite a few of the categories. especially the online services, third-party seller services, and AWS. So the main thing I'm really focusing on with Amazon moving forward is the Amazon Web Services, because that's where the high margins is, and now I really like to invest in companies which can generate high margins. So, will NEPI invest in Amazon? Well, I've virtually given that away by the title of this video. I will look for an entry point sometime in the future. In fact, what I more likely will do is buy a little small stake in Amazon, and then I might add to that little portfolio as I move forward through the next, who knows how long. Now, the company does look expensive if you look at those ratios alone in isolation. But when you look at the growth, I think the growth really justifies the valuation. And the main reason behind that is we're seeing exponential growth in operating cash flow, even in revenue and profits, and that corresponds to the exponential growth in the share price. So in this case, a little bit different than Apple. So Apple's share price growth was driven by multiple expansion, and that can't continue. That has to stop, because you don't want to see those PE ratios keep going up and up unless you start to see financial growth as well. So a little bit different with Amazon. We've seen that financial expansion to justify the share price growth. So you can't say this can't continue forever, because if that financial expansion just keeps on continuing, that share price growth will continue with it. And that's a little bit different than Apple. Apple, I need some proof that they're going to start seeing a bit of growth in their operating cash flow, profits, and revenue in the next few years. I want to see that proof, see that reasoning behind why that's going to grow in Apple's case. With Amazon, I can see that continuing without much thought, in fact. So this is a behemoth of a company. I actually mentioned that a few months ago to someone. This is a behemoth of a company. I've just said they're taking over the world in jest. In some respects, they are. I actually am a user of Amazon. I'm starting to use their services more and more, just because I find I can find stuff on there cheaper than other places, and that's the main thing, is cost. The big question is, can that exponential growth continue? Of course it can continue, but even if it starts to slow down a little bit, you're still going to see that share price growth moving forward with the financial expansion. Amazon Web Services, I have no doubt that's going to be the main driver for the share price growth, the operating cash flow growth moving forward. That's where the margins are, and that's where I think we're going to see a lot of growth in the next decade. International growth too, so they have a lot of room to grow internationally, even though those international growth stories probably not a lot of margins with that. They're going to have to do a lot of sales to get any sort of profit with it. And this is a really fascinating company for me. It really intrigues me that what they're doing is, I just heard all this rhetoric in the past 5 or 10 years that this is an expensive company. Why would you buy into Amazon? It's just too expensive. And I think that sort of story is kaput. There's a reason why it is expensive, and that's because the growth is substantial. It's exponential growth, and when you have exponential growth, you've got to see that share price growing with it, and that's what we're seeing with Amazon. So this is an intriguing company. At this point in time, it's a buy for me, and it's I've got Amazon is greater than Apple, but at only this point in time, that could change. Especially if Apple comes out with some innovative products, new products that are going to change the world. And they've done that before, so don't discount Apple moving forward. But at this point in time, Amazon is a buy and Apple is not. So that's all I've got on this video of NEPI Invest USA, and taking a look at why I'm a buyer of Amazon. And hopefully I'll buy into Amazon and hold them for the next 10, 20 years, and their share price just continues to grow at an exponential rate. I don't think that can continue forever, because that would mean Amazon has taken over the world, because that means the Amazon market cap would probably be more than some countries, in fact even more than the United States, and that's going to be an impossibility. So the exponential growth does have to slow down just by rationale. If you just think about rationale, it has to slow down at some point in the future, but when is probably the big question. So that's all for today. Have a good day, and just remember that I'm not a financial advisor, so If you think I'm giving you any advice and you might follow that advice, probably don't just follow my advice. I'm just doing these videos for educational, entertainment, and research purposes, particularly research purposes for myself, in this case of Amazon. So if you do need some advice, make sure you seek out a qualified financial advisor who can speak to your own financial circumstances and give you the news you need or the advice you need. So that's all today. Have a good day. Bye.